Picture this. It's early 2025, and President Donald Trump, now in his second term, is shaking up the global economy with a bold, high-stakes trade strategy. Out of nowhere, on February 4th, he signs off on hefty tariffs, slapping a 25% duty on goods coming from Mexico and Canada and adding another 10% tariff on Chinese imports. His reasoning? Fixing trade imbalances and bolstering national security. But not everyone's on board. Almost instantly, key trading partners push back, warning of economic fallout. Then, just when the dust starts to settle, Trump's team unveils the Fair and Reciprocal Plan on February 13. This blueprint takes direct aim at what the administration sees as unfair trade practices from countries like Brazil, India, and even longtime allies in the European Union. The message is clear. The US isn't playing second fiddle in global trade anymore. But things heat up even more on February 27th. In a move that rattles markets, Trump announces another 10% tariff on all Chinese imports, blaming Beijing for not doing enough to stop fentanyl from pouring into the US. And this time, there's no grace period. It's set to hit just a week later on March 4th. The very next day, on February 28th, the White House cranks up the pressure even further, floating the idea of new tariffs on the European Union and other major economies. It's clear, this isn't just about China anymore. With businesses sounding alarms and economists predicting turbulence, something unexpected happens on March 3rd. Trump pulls back some of the tariffs on Mexican and Canadian goods. The move catches everyone off guard. Maybe a sign of compromise, maybe a strategic recalibration. But any hopes for cooling tensions are short-lived. March 4th arrives, and the 10% tariff on Chinese goods kicks in as planned. Beijing isn't about to take this lying down. Within hours, China slaps retaliatory tariffs of up to 15% on U.S. agricultural products, leaving American farmers and exporters caught in the crossfire. The financial world was thrown into chaos. By March 5th, the stock market had taken a nosedive, with the Dow Jones Industrial Average shedding more than 1,300 points in just 2 days. Investors, already on edge, were now in full panic mode. The reason? President Trump's unpredictable trade policies had sent shockwaves through the global economy, leaving businesses scrambling and markets spiraling. But if anyone thought this was the moment Trump would rethink his approach, they were mistaken. Just a few days later, on March 8th, he doubled down, threatening new tariffs on Canadian dairy and lumber products. His argument? That Canada had been stacking the deck against American businesses with unfair trade barriers. This only worsened tensions between the two countries, adding fuel to an already raging economic fire. The back-and-forth nature of the administration's tariff decisions, one day imposing new trade restrictions, the next suspending them, left business leaders, investors, and even foreign governments deeply frustrated. Markets became more volatile than ever, with prices swinging wildly in response to every new announcement from the White House. Meanwhile, as trade battles escalated, especially with China, the damage started spreading beyond just Wall Street. The US dollar, once a symbol of global stability, began to slide. Investors, unsure of what might come next, started pulling their money out of American assets. What was once considered the world's safest currency was now losing value at an alarming rate. Sudden policy shifts, surprise tariffs, and unexpected reversals had traders on edge. Instead of its usual role as a safe haven during uncertainty, the dollar became a casualty of its own government's decisions. This rapid decline sent ripples through other markets. Stocks, commodities, and international currencies all felt the impact. At the core of it all was Trump's tariff war, a strategy that, rather than strengthening the economy, was now dragging it into unpredictable territory. The financial markets were on edge, and the US dollar was feeling the pressure. Weeks of chaotic trade decisions had rattled investors, sending the dollar index, which tracks the greenback's value against major currencies, tumbling nearly 5% from its January peak. What started as a strong year quickly unraveled as fears grew that President Trump's aggressive tariff strategy could stall economic growth. At first, the dollar had been riding high, propped up by solid economic data and expectations that the Federal Reserve would stay on the sidelines. But by late February, that confidence crumbled. On a single day, the dollar index plunged more than 1% as investors scrambled to adjust to the shifting trade landscape. It was a brutal wake-up call, one that sent shockwaves across global markets. Meanwhile, other currencies wasted no time in taking advantage of the dollar's slump. The euro surged nearly 3% in just days, climbing to around $1.07 as investors turned to the European market for stability. Frustration with the US administration's trade decisions, coupled with stronger economic prospects in Europe, pushed traders to rethink their bullish stance on the dollar. Not all currencies, however, were so lucky. The Canadian dollar and Mexican peso took a heavy hit after Washington announced new tariffs, as markets grew nervous about the future of North American trade. On the other hand, so-called safe haven currencies, like the Japanese yen, saw gains as investors rushed to move their money away from the unpredictable US markets. Stocks weren't spared from the chaos either. The S&P 500 suffered one of its worst single-day declines of the year when the White House abruptly dashed hopes for tariff relief on Canadian and Mexican imports. Investors feared that an escalating trade war would slash corporate profits, disrupt global supply chains, and weaken consumer demand. The uncertainty sent the VIX, Wall Street's Fear Index, soaring, highlighting just how sensitive the markets had become to every new tariff headline. Amid the turmoil, investors began pouring into traditional safe haven assets like gold, driving prices to record highs. The precious metals' rise underscored the deepening uncertainty surrounding the economy. Even U.S. Treasury bonds, usually a go-to option during market panic, saw only modest gains, as concerns about stagflation, rising prices paired with slowing growth, kept bond yields from dropping as expected. President Trump's ever-changing tariff policies have thrown global commodity markets into disarray. Prices for key resources like oil have become unpredictable, reacting sharply to every new trade dispute. One week, traders watched WTI and Brent crude tumble by 3 to 5% as fears grew that escalating tariffs would slow down global energy demand. But in a strange twist, other commodities, like industrial metals, saw sudden price spikes when supply chains were disrupted by new trade restrictions. For businesses that rely on stable pricing, this was a nightmare. Producers, shippers, and manufacturers worldwide were left scrambling, unsure of what costs they would face next. Without clear direction, companies hesitated to make big moves, uncertain whether their materials would be slapped with a 10% or 25% tariff in the coming months. But the biggest hit wasn't just to supply chains, it was to confidence. The US had long been a top destination for investment, a place where companies felt secure putting their money. Now, that trust was fading. Major banks reported a clear trend. Investors were starting to look elsewhere. Businesses, nervous about the next unexpected tariff announcement, froze hiring and delayed expansion plans, waiting for some kind of stability that never came. Even America's closest allies weren't spared. Canada and Mexico, longtime trade partners under NAFTA and USMCA, suddenly found themselves hit with 25% tariffs. The reaction was swift: anger, retaliation, and growing fears of a prolonged economic standoff. While the White House floated temporary exemptions, the broader message was clear: no country was safe from the next round of tariffs. Meanwhile, the US-China trade war took another aggressive turn. Tariffs on Chinese imports were doubled from 10% to 20%, sparking another wave of retaliatory measures from Beijing. Instead of winding down, the conflict dragged on, casting a long shadow over the global economy. And just when businesses thought they had a handle on things, new threats emerged. By late February, Trump announced a plan for additional tariffs, so-called reciprocal levies, targeting even US allies in Asia. The details were vague, the demands unclear, but the message was unmistakable: more trade fights were on the way. What made matters worse was the constant policy whiplash. One day, the administration would announce tough new tariffs. The next, they'd suspend them, only to bring them back days later. This back and forth left businesses unable to plan, throwing supply chains, pricing strategies, and hiring decisions into chaos. The constant flip-flopping on trade policies has created an atmosphere of uncertainty and instability, making the US dollar more fragile than ever. Markets thrive on predictability, but the erratic nature of tariffs and trade disputes has thrown investors and businesses into a whirlwind of doubt. Instead of strengthening America's economic position, these aggressive trade tactics have backfired, shaking global confidence in the US as a reliable economic partner. Countries that once depended on steady trade relations with Washington are now looking elsewhere, and that shift is taking a toll on the dollar's standing in global markets. Retaliation has only made things worse. Nations on the receiving end of US tariffs have responded with their own trade barriers, sparking a cycle of escalating tensions. Every counter tariff further disrupts supply chains, raises costs for businesses, and adds more pressure to an already struggling economy. Manufacturers have been hit especially hard. Factories that once relied on stable input costs and predictable trade routes are now grappling with higher prices and logistical nightmares. The latest manufacturing data shows a clear slowdown. Production is dipping, and key indicators are flashing warning signs. February's numbers from the ISM Manufacturing Index revealed a troubling decline, with some sectors teetering on the edge of contraction. Even the Federal Reserve has taken notice, with its Beige Book report documenting how trade uncertainty is dampening economic growth. Business leaders are hesitant to invest, expand, or hire when they have no idea whether next week's policy shift will make their plans obsolete. Globally, the warning signs are just as stark. Both the World Bank and the IMF have flagged these ongoing trade battles as a direct threat to economic stability. Countries that depend on exports are feeling the pain, and the broader investment climate has soured. When the world's largest economy is in constant trade turmoil, it drags down global growth. Economists agree on one thing: uncertainty is the biggest killer of business confidence. A company can adjust to a 10% tariff, but if there's a real risk that rate could jump to 25% overnight, it freezes investment. No one wants to pour money into expansion, research, or hiring when a single tweet from the White House could change everything. The impact is now reaching consumers. Tariffs function like a hidden tax, driving up the cost of imported goods. Electronics, appliances, and everyday essentials are getting more expensive, forcing households to stretch their budgets further. If this pattern continues, economic growth slowing while prices creep upward, the Federal Reserve will find itself in a tough spot. Investors are already bracing for a worst-case scenario: stagflation. This toxic mix of weak growth and rising costs could shake market confidence even further and erode the dollar's dominance in global finance. And in the background, another shift is taking place. Countries around the world are actively reducing their reliance on the US dollar, seeking alternatives for trade and financial transactions. What was once the unquestioned global reserve currency is now facing growing pushback from major economies. In just the past month, a wave of major financial shifts has swept across BRICS nations, Latin America, and even parts of Europe, accelerating efforts to move away from the US dollar. Countries are striking trade agreements in their own currencies, adjusting their central bank reserves, and openly challenging the dollar's long-standing dominance in global transactions. This movement isn't just about economics, it's deeply tied to politics. As tensions rise between the US and key global players, many nations are rethinking their reliance on the dollar, fearing it makes them vulnerable to American sanctions, interest rate hikes, and economic policies beyond their control. While experts agree the dollar won't lose its top spot overnight, the momentum behind this shift is stronger than ever. For decades, the US dollar has been the world's go-to reserve currency, used for everything from trade deals to cross-border payments. But recent data shows that its share of global central bank reserves has dropped to its lowest point in decades. A major driving force behind this change? The BRICS bloc: Brazil, Russia, India, China, and South Africa, along with other emerging economies. These nations see breaking free from the dollar as a way to shield themselves from Washington's financial influence and create a more independent economic system. Recent global events have pushed this movement into overdrive. From sweeping Western sanctions on Russia to rapid U.S. interest rate hikes that rattled international markets, the pressure to find alternatives has never been higher. In February 2025, top BRICS officials met to solidify plans for expanding trade in their own currencies, brushing aside concerns from Washington. Brazil's foreign ministry confirmed that the bloc is actively developing a system that allows members to settle transactions without touching the US dollar. This isn't just theoretical. In 2023, Brazil's trade with BRICS nations hit $120 billion, far surpassing the $83 billion in exports to the US and Europe. Yet despite the strong numbers, much of this trade still settles in dollars, something officials want to change as soon as possible. Brazil's Foreign Minister Mauro Vieira put it bluntly: trade within BRICS countries is nowhere near its full potential. The main reason? Too much reliance on dollar-based settlements, creating unnecessary bottlenecks and extra costs. While some have speculated that BRICS could launch a common currency, Brazil, which holds the BRICS presidency in 2025, has made it clear that's not happening anytime soon. Brazilian officials clarified that while the idea of a BRICS reserve currency has been tossed around in political speeches, it hasn't been seriously discussed on a technical level. Instead, the priority is more immediate and practical solutions, making cross-border payments in local currencies easier and faster. The upcoming BRICS summit in July will focus on this, with discussions on integrating national payment systems, adopting fintech solutions, and even leveraging blockchain technology to streamline transactions. One example of this shift is Brazil's instant payment system, Pix, which has already overtaken cash and credit cards as the country's most used payment method. Officials are exploring ways to link Pix with other BRICS nations' payment networks, making it easier for businesses and individuals to send money and settle trade in their own currencies without relying on the dollar. Brazil isn't new to this approach. It already has a local currency payment system with Argentina, Uruguay, and Paraguay, allowing trade to be settled in Brazilian reals instead of US dollars. Though still small in scale, Argentina alone used this system for nearly $1 billion worth of trade last year, about 10% of its total transactions with Brazil. Officials believe new technology and expanded participation could make these systems even more efficient. Among the BRICS nations, Russia and China have taken the most aggressive steps to eliminate the dollar from their trade transactions, especially after US and European sanctions hit Russia in 2022. By early 2024, the Kremlin reported that over 90% of Russia-China trade was already being settled in their own currencies, mainly the Chinese yuan and Russian ruble. By 2023, the Chinese yuan had quietly overtaken the US dollar as the most traded foreign currency on the Moscow exchange. This shift wasn't just happening on paper. Russian banks were holding more yuan than dollars, a stark sign of how Moscow's financial system was pivoting toward China. Even at the government level, Russia moved much of its sovereign debt away from the dollar and euro, tripling its yuan-denominated loans to over $46 billion. This wasn't just about preference, it was about necessity. With Western sanctions making dollar transactions risky, Russia sought alternatives, and the yuan became the obvious choice. To keep trade and financial flows moving, Russian banks linked up with China's CIPS payment system, an alternative to SWIFT, alongside Russia's homegrown SPFS network. These connections allowed businesses in both countries to move money freely without relying on Western financial institutions, making transactions far less vulnerable to US sanctions. The impact? A dramatic yuan takeover of Russia's trade. Before the Ukraine conflict, China's currency made up just 1% of Russia's total trade settlements. By 2023, that number had jumped to 20%. It's not just Russia. The BRICS alliance, originally made up of Brazil, Russia, India, China, and South Africa, has been expanding, welcoming new partners that further accelerate this shift. Recent additions include Saudi Arabia, the UAE, and other key economic players, giving BRICS even more influence in global trade. With these new members, BRICS now represents 45% of the world's population, 25% of global trade, over 31% of global GDP, and many of these nations are already trading outside the dollar system. Saudi Arabia has started selling oil to China in yuan, with contracts that can be converted into gold through the Shanghai Exchange. Iran struck a deal with China in 2023 to receive commodities like oil instead of dollars as payment for a massive infrastructure project. Russia and China have abandoned the dollar almost entirely in bilateral trade, using their own currencies for over 90% of transactions. But BRICS isn't just focusing on traditional currency swaps. It's also exploring digital solutions to bypass the dollar. One of the most notable projects is mBridge, a pilot program involving China, Hong Kong, the UAE, and others. This system successfully tested cross-border transactions using central bank digital currencies, CBDCs, including a digital yuan purchase of oil from the UAE. These developments show that the BRICS bloc is moving toward a more independent financial ecosystem, where local currencies and digital payment systems take center stage. At the October 2024 BRICS Summit, Chinese President Xi Jinping and Russian President Vladimir Putin openly supported the creation of an alternative payment system that does not depend on the US dollar. While details remain vague, the direction is clear. De-dollarization is no longer just talk, it's policy. Russia had already made its position known back in 2022, calling de-dollarization an inevitable process. But not all BRICS nations are moving at the same speed. India and Brazil remain cautious, wary of actions that could be seen as too aggressive or disruptive. India has experimented with rupee-based trade in certain deals, but still relies on the dollar for most transactions. Brazilian President Lula has been vocal about the benefits of local currency trade, but he also stressed that no one in BRICS is looking to completely ditch the dollar. Instead, BRICS is taking a gradual, voluntary approach, as outlined in a recent joint declaration. The goal isn't to eliminate the dollar entirely, but rather to give member nations more flexibility and control over their financial systems. Across Latin America, countries are making bold moves to reduce their dependence on the US dollar by using alternative currencies for trade and finance. Two of the biggest players in this shift are Brazil and Argentina, each taking steps to reshape how they conduct international transactions. As South America's largest economy, Brazil took a major step toward reducing dollar reliance when it finalized a deal with China to trade directly in their own currencies, the Brazilian real and the Chinese yuan. This agreement, signed in April 2023, set up a yuan clearing arrangement in Brazil, allowing businesses to bypass the dollar completely when buying and selling goods. Given that China is Brazil's top trading partner, with over $150 billion in annual trade, this move helps cut transaction costs and protect businesses from unpredictable currency fluctuations. For China, this deal is part of a broader push to expand the global use of the yuan, particularly among key economic partners. Brazilian President Luiz Inácio Lula da Silva has been outspoken about the issue, questioning why global trade should always be tied to the dollar and advocating for alternatives that better serve local economies. Meanwhile, Argentina, struggling with economic turmoil and a shortage of US dollars, has been turning to China's yuan for trade and financial support. In 2023, Argentina began paying for Chinese imports in yuan instead of dollars to ease pressure on its foreign exchange reserves. The country also activated a currency swap agreement with China, unlocking access to over $18 billion in yuan liquidity from China's central bank. By mid-2023, Argentina had settled over $1 billion in yuan-denominated trade, making it one of Latin America's biggest adopters of China's currency. This allowed the country to keep essential imports flowing despite its limited supply of dollars. Other nations in the region, like Bolivia and Venezuela, have also experimented with yuan-based trade as part of a broader strategy to reduce reliance on the dollar. Beyond currency swaps, regional leaders have floated an even bigger idea: creating a shared currency for South America, tentatively named the SUR, Spanish for South. Brazil's President Lula has been a key advocate, arguing that a common currency could make trade within the region smoother and less dependent on the dollar. However, the proposal is still in its early stages, and most trade in Latin America continues to be settled in existing national currencies. In the meantime, Brazil has been expanding its local currency payment system within Mercosur, making it easier for countries like Argentina, Uruguay, and Paraguay to settle trade directly in their own currencies instead of the dollar. While these efforts are small compared to overall trade volumes, they mark real steps toward reducing dollar dependency in the region. Compared to Latin America and BRICS nations, Europe's approach to de-dollarization has been more subtle. The euro is already a major global currency, but European leaders and businesses have been quietly working to diversify away from the dollar in key areas, especially energy trade and financial transactions. By 2024, the euro surpassed the dollar as the leading currency for EU exports, with over 52% of trade invoiced in euros, compared to 32% in dollars. On the import side, the dollar still accounted for 50% of EU transactions, largely because of energy imports. But even here, a shift was underway. 41% of EU imports were now settled in euros, showing a slow but steady move away from dollar-based trade. Europe has been actively searching for ways to reduce reliance on dollar-based payment networks. When US sanctions cut off Iran and Russia from global financial systems, European nations developed workarounds to keep trade flowing. In 2019, Germany, France, and the UK launched Instex, a system designed to allow European businesses to trade with Iran using euros and other local currencies rather than dollars. Though it saw limited use, it proved that Europe was willing to challenge the dollar's dominance when necessary. After Russia's invasion of Ukraine in 2022, European countries were forced to pay for Russian gas in rubles, a demand imposed by Moscow. While this system didn't last long, it showed that European nations could adapt to non-dollar transactions when needed. Europe's biggest energy companies are now experimenting with non-dollar payments, especially when dealing with China. In early 2023, France's Total Energies and China's Sinopec made history by completing the first ever liquefied natural gas, LNG trade, settled in yuan. Later that year, France's Engie followed suit, also settling an LNG transaction with China in yuan instead of dollars. These deals suggest that European businesses are becoming more comfortable with non-dollar payments, especially in the energy sector. At the same time, the European Central Bank, ECB, has been increasing its holdings of yuan, joining a growing number of European central banks diversifying their foreign exchange reserves. While the dollar remains a key reserve currency for Europe, policymakers are gradually shifting toward a more balanced approach, ensuring that global financial changes don't leave the region overly exposed to US monetary policies.